So real quick, I'm taking the kids to see Janet Jackson tomorrow. That's why that slipped. Okay, moments ago, first quarter New York Fed senior lending officer survey out. This report has taken on so much more significance than normal. Investors have been trying to gauge the impact of this banking scare. Remember, in the fourth quarter, we'd already seen banks starting to tighten up. All banks on credit cards had tightened up 28% on credit cards, 19% on autos. The big banks were even more stingy, 33% for credit cards, 30% on auto loans. Here's what's interesting, though, folks. Demand for both also dropped, though. There was a massive drop. There was a 43% drop in auto loans. So right now, Edward Lawrence is in D.C. He's combing through the reports. We're going to go through him in just a moment. First, I want to bring in Bianco Research President Jim Bianco. And Jim, I want to begin with the blame game because fingers are pointing like crazy. There's talk of doing all kinds of things that border on desperation. I want you and the audience to listen to extraordinary comments. This is Gary Cohn, a member of the Systemic Resolution Advisory Committee of the FDIC. Take a listen. Okay. It's coming up in a moment, I promise you. In the meantime, before that comes up, when it does come up, one of the things we're hearing about is that the public, what they should know about the banking system. And the debate is whether they know too much. I believe in full disclosure, even if it does create anxiety. How often should the American public be notified of the state of the health of the banking system?
Oh, I think they should be notified regularly and often on the state of the banking system. It would also serve as a check to allow bankers to not get out of control with too lax lending standards or doing other things that are ill-advised, because they would be called in public to account and explain their positions. We'd be much better off than burying it.
So I've got this thought. It's just something even though we botched it a little bit here, you have to listen to it. The audience will not believe this. Take a listen.
I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank? Like, my insurance company doesn't tell me what they're doing with my assets. They just assume they're going to pay my claim, right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do.
Now, I will say this. I thought the night that President Biden spoke with the Silicon Valley thing and subsequent times that we heard from Janet Yellen, I do believe they botched it. And I think there were political reasons for that. And I don't think they were straight with the American public. Since then, we're getting a lot of finger pointing. Folks are blaming short sellers and put buyers. In the meantime, some people are just blaming social media, which obviously did play a role in getting the message out. But if the people in charge would take control, we don't have to worry about social media, do we?
No, we don't. And that was not a good comment by Gary Cohn. He should know better. The public can handle the truth. They've always been able to handle the truth. It's allowing bankers to behave irresponsibly and then not calling them on it is where the problems come. And what we've learned is that regulators and other people in Washington don't call them on any of this. So make it public what they're doing and have them explain themselves. I don't think it would cause a panic. I think it would prevent a panic. Panics always happen because people are ill-informed. If you give them information, they're no longer ill-informed, and then they don't panic.
I love that. By the way, let's go down to D.C. Edward Lawrence is going to give us the initial highlights from this bank survey. Edward.
Yeah, and when we're digging into this, particularly this is important because they said the bank failures, we want to see exactly the effect on the economy. So on balance, in the first quarter, the standards tightened and demand weakened for specifically credit cards and auto loans in this. Residential real estate loans also were a little bit tighter for this, but demand weakened further in the first quarter. Now, for credit cards, let's dig into the numbers here a little bit. You talked about it. For credit cards, substantially tightened or somewhat tightened, 32% for credit cards. That is up from 28%. Staying the same, though, on the downside, when you talk about 65% seeing moderately weaker or substantially weaker when related to the amount of households that are asking for credit cards. That is about 65% down from 72%. So that demand is going down. So demand from people asking for credit cards is little unchanged. So let's get into this. So credit cards almost unchanged. 17.4% people were looking for credit cards are only down about 4% related to this. Now, for auto loans, let's move on to that. Tightened somewhat. 29.4% saw auto loans tighten somewhat. That includes 5.9% saying considerably tightened on that credit condition for auto loans. The demand for auto loans, that was also coming down here. Now, earlier today, I heard Senator Bill Cassidy talking on Fox News Channel. He was talking about a conversation he had with Michael Barr, saying he's still concerned about some banks, a handful of banks is the way it was described to him, that have some concern related to this going forward. They are looking, the federal authorities, Federal Reserve, to make sure that those deposits stabilize in this. But we are, again, seeing some tightening and weaker demand for some of these things like auto loans and credit cards. Charles?
Thank you very, very much. Jim, I want to go back to this first board. So credit card tightening was at 28%, and for the fourth quarter is 33% now. I'm going to get the number again for autos, but we do know that demand is weakening. We know the credit itself is tightening. Now, this, by the way, Friday, we got that consumer credit report that came in substantially higher than the street expected as well, and we saw a big percentage jump in credit cards. So, taking all this information into account, you've been following this banking situation better than anyone. Where do you think this leaves the Fed right now?
Well, I think, keep in mind, too, that this is data that is now 5 weeks old because it's through the end of the first quarter, and only the last 3 weeks of the quarter is when we had the real banking concern after Silicon Valley failed. So this is missing what happened in April. I think as far as the Fed goes, it's all signs that the real economy is going to slow and slow more. Now, whether that moves the Fed to not tighten more or not raise rates more, or maybe cut rates, Jay Powell made it very clear he's focused on inflation. He's not focused on real growth. So I don't think it's going to move the Fed. But for the rest of us that care about real growth in the economy, this report suggests it's going to be a little bit harder to see real growth.
In the meantime, for the banks, I was at a bank, a regional bank that I bank at. I've got a few bank accounts, but I sat there. I sat with the manager. We talked. She said, some folks have taken in deposits. Not really panic. She mentioned that their bank was offering a 4% money market. I'm like, come on. I gave her that look, and then she admitted, yeah, the bank down the street was offering 5%. So, we've got this massive swell right here, and this is one of your charts, into these money markets. And depositors are smart. They want the best rate. So how do regional banks navigate all of this?
It's really hard for them to navigate this because market-based rates, money markets, are just as safe as a bank, and they're offering market-based rates that are near 5%. A bank can't really offer 5% because their loan book and the securities they own don't generate 5% returns for them that they could pass along to their customers. It's more like 3% that they pass along. So if they're offering 4 or 5% yields, they're most likely on deposit accounts. They're most likely losing money on those accounts. And what's important to understand about this, I've referred to this as a bank walk. It's not a bank run. It should not lead to any bank failing, but it will squeeze the profitability of all of these banks as they see assets leave, and the only way they can hold them is to raise the deposit rates that they offer, squeezing their own profitability. So it does put the bank in a bad place, but it doesn't put the bank in a failure place.
Right. So it is a tough game of attrition now, and the bigger, more well-funded banks do have the advantage, it seems like. Jim, thank you very much. Appreciate it.
Thank you.
All right, folks, I want to bring